Hey, welcome. Jay here, smarthelping.com. We're going to look at how to calculate compounding rent growth in real estate. It's going to be cool. Um, Note in all of the real estate models I've built here at smarthelping.com, these all have rent growth properties in them for compounding and dynamic based on the start month and all that stuff. So we're going to get into it. Um, so let's jump into the Excel sheet here. So rent growth is basically when you buy a property or you acquire a property, over time, the rents are likely to go up. In every single real estate model I've done, there's always some assumption about rent growth over time. There's a couple ways to do it. The first way, in the most simplistic way, and I'll do a couple of these, and this spreadsheet will be available in the description box below for free. I'll put it into a Google Sheet at the end, but let's say your expected, you might have in-place rent, and then you might be raising the rent. So you'll have some number saying however you get to it. You might have different units and rent per unit, so you get some number that says your monthly or annual rent. So on an annual basis, there's a bunch of different ways. So I'll try to cover all the main ways that this is done. So the first way is on an annual basis. You say, here's my expected year one rent, whatever. Let's say 250,000. And this is top line gross potential rent before any vacancies or anything else. So you get your top line expected rent for the entire uh, use case, and then you just have some growth. So you have. We'll just put our table going over here. Let's say you got some time. We'll just do 10 years. We have year one, which is going to be this, and then we want to say, well, what if it grows at some percentage each year? Oop, let's say, we'll give it a decimal. Okay. And the first year, I mean, you could, if this was your in place and you wanted that to be higher, you could always just say the first one equals, and you just multiply it by the rate plus the amount here. And then going forward, you can say, well, the second year I'm going to increase rents by, we go previous year's rent times bracket 1 plus the growth rate. So this is the easiest way to do it. And then there's your top line rent for each year. Now, and we'll go into a monthly. This is just going to be annual. Then I'll do a monthly one. Right in the same video. It'll be after these yearly ones. So that's the first way to do it by year. Uh, the other way, well, I guess actually that's the only way to do it if you've got yearly rents. So let's just move into monthly. If you've got monthly rent and you want to figure out how that's going to grow over time, you might start with a average rent per square foot or just your expected rent. But let's just show you. Let's get a couple years of time in here. We'll go up to 4 years, 48 months, so you can get the point. So let's say you've got here. Now you would have a different number. You'd have month one rent, and this would be based on all your rent rolls, everything else. And you could break it down into a weighted average rent per unit and then your total units, and you can grow your occupancy as well as the rent. But right now we're just talking about the growth factors for rent. So let's say month one rent, let's say it's $8,000. Fine. And we want to say um, every year it grows by some percentage. The first way to do this, and there's a couple, we'll say you've got the uh, you've got the year and the rent growth. And you can do it two different ways. You can apply a compounded monthly growth rate to an annual amount. So at the end of the 12 months, it compounds in a way where the total growth for the year is what your annual rate was. Or you could define it as a single rate, and it applies to that rate in each month. The thing is, what if you don't start construction till, say, month 8, or you don't actually start collecting rent till month 8 or month 17? and then you need to start counting dynamically from whatever month that is. So in that case, we have a table. In this case, um, we've only got 4 years, but it's okay. We can just put whatever here. So you've got your years. You put rent growth down here, similar to the other model a little bit. And year 1 is usually 0 because it's just going to be whatever there is there. Year 2, whatever, let's just do 3% here. And I want to say, what if the rent start month is in month 5? Well, then I need to put in a dynamic assumption that says count, so age, and we also need to put, so we have month 1 rent, we have month 1 start date, and let's just say we put in a month here, let's just say we start in month 7, and let me get rid of these grid lines. Okay, so I need to know the age, so I simply go if the month here equals this, then 1, because it's month 1 technically, and otherwise 0. And then I wrap that and I say if the previous month, so if E11 is greater than 1, then do E11 plus 1. Sorry, if E1 is greater than E11 is greater than 0, then start counting. Do E11 plus 1, otherwise do what we had there. So now look at, you've got, oh, let me lock all this stuff here. So this is locking. I believe that's it. There we go. So we have this dynamic counting function now, and we know what year it is for the life of the property, or what month it is. And then we put the year, we simply go equals round up, F10, F11, divided by 12, 0. And this converts months to years dynamically. Remember, the whole point of this is so we can do it dynamic. So I know what year it is, and I put in, what's the growth in each year? Well, I want to know the compounded growth. Well, actually, this is a lookup. So I can just look up the growth. Actually, in this sense, you can't. Unless you literally, well, you could. In this case, you would have to go with the amount here, and then you do this times 1 plus the rate, and then you would just look up the rent amount with a index formula. So there's my rent in each year in this case. So I have this number probably coming from a rent roll, and I say, well, year 1 is going to be the same as whatever this is, and then I start growing it here. And then so the rent becomes a formula. I just say index and pull the rent amount if my row number matches the year. And that's that formula. And then if error, this is if it's 0. Do this. Okay, so this is one way. We'll get into a couple different ways here. So we lock the E, and now I simply have my rent amounts. And you can see it's going up. This is monthly rent. It's going up each year. It's not increasing monthly. It's increasing every year by that amount. So that's one way. Okay, the other way, let's say I want to increase the rent by 3% each year but I want to do it within the amount. So like I want to go from 8,000, and then by the end of the 12th month, I want to be at, 8,240. So 3% higher. In that case, you do a little bit different. So I'm trying to think if I want to do this one next or not. Let's think here. So I have this. Can we do it? Well, and this is a rent. I'll just highlight all the rent calculations so you have it. So there's the rent there. This one would be annual rent. Okay, and then now I want to do a situation where I'm compounding it by 3%, and I believe this 3% can't change year between the different years, because if I'm in like year 7 or 4 or whatever, and I start to change the rent growth rate, I'm trying to think if this would work. Well, yes, technically it would. Okay, so what we would do, let's just do a secondary table for this. And so we say rent growth. We don't need this. We just need the rate. But what we do need is we need to know if this is the annual growth rate, we need to know what the monthly compounded growth rate is in each year. So we're converting this to a compounded rate. And so let's do that, which let me try to think of the calculation. I believe uh, it is 1 divided by bracket 1 plus the rate raised to, whoop, close bracket, raised to the power of 1 minus the amount of periods, or divided by the amount of periods, minus 1. Minus 2.25. All right, so I have a bracket issue here, I believe. Now this should be, so then let's just check it. So let's say I have a period of 1 year here, and I start with this amount, and I want to end at 3% higher. So if I compound the growth rate by that, we should get it. I'm just checking the calc here because I want to make sure. Okay, 8,240, and that is the amount. You can see 8,240 is right here. So, and if I offset it by 1, we start with month 1 through 12 is this amount, and then by month 13 we're now up to 8,240, which is what you would do. Now, in that case, you simply apply this calculation to each of these. Let's say this was 4%, 2%, 1%, 1%, or whatever it is. Each period of these years, this is what you're growing the monthly rent by. So let's do that calculation. So now I still need to know, we'll just put this down here. We can clear this out. So this is monthly rent for this way. Let's do it this one. So here, when I do my index, I want to say the growth rate. So my initial rent is going to be if this month here, our count function equals the month here, then I want month 1 rent. Otherwise, 0. And then I do another calculation where I say if the previous month is greater than 0, then simply take the previous month times 1 plus, and now my rate is an index formula. And I want to index this based on the year I'm in. And I'll show you how cool this looks right in a second. Oh, we want to match the row with the year we're in. Okay, and if that's greater than 0, do that times that. Otherwise, if that equals that, figure out where our other 0 is at. Okay, and then we lock these. Now watch how cool this is when I drag this over. We need to lock 11 or E39, or no, if this one, D11 and D12. I believe that should work. Nope. What happened? So if this is greater than 0, then do that times 1 plus the rate. If it's not greater than 0, then check if N11 is equal to D11. If it is, then pull D12. Now so here's that. Okay, my index formula is not closed all the way. So we need to close that no column there. Yep. Now what are we at? Index match. So that's shut off. Otherwise, oh, we gotta close another one. If that is okay, I think there we go. Okay, so we're in month 7. Oh wait, this actually needs to reference not the age here. We need to reference the actual month, start month here. Okay, so year 1 we're saying is 0%, but let's say it's not. Let's say year 1's actually growing by 3%. Well, look at that. We start at 8,000 and then we go 8,020, 8,040, and so on. And then look what happens when we get to month 13. We're at 8,240. Whereas in this one, we did annual growth per year, so we don't get to 8,240 until the start of year 2. Whereas here, we get to it evenly over time. And then let's drag this all the way out. And you can see now, this is probably the most complicated formula structure people get struggling with real estate. It's this one here. But this is it. You just do a lookup table. You have your rent growth in each year. You convert that to a monthly compounded growth rate, and you just increase the rent by this amount each month based on whenever you start. And you can allow for a dynamic start month with this logical structure. So it's pretty valuable stuff, I think, here. And this will get you started on your rent roll modeling and rent growth. And you can see if we go, so let's put year 2 at 5%, so you can see a different number. So at 5%, now, let's say we started at 8,000, right? And we grew it by 3%. And then we grew it by 5%. So it's a compounding rate per year. Now look at this. So we should be at 8,652. If I did that right. Let's see. So we go here, 12 months, month 13, we're at 8,2. Wait, what did I do here? Hold on. We should be at 8,240. Year 1. This. Index year. Okay. So I'm indexing period 1, right? That's the right period. So right now it's 0.25%. Let's check this. That's why you always do sanity checks on this stuff. Let me make sure this equals this. True. Okay. So we compound it 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Month 13. I see. So here's what it is. Month 13, we now are going by a 5% compounding growth rate. So we're increasing by a little bit of a different amount in this year. If this were 3% again, then yes, month 13, we get to 8240, which is the same as this. But if we're going at 5%, we now have in month 1 of the second year, which is this, we're not going by we would have in theory gone by 3. We would have got the 3% growth rate in the starting amount at that point. Um, if this were also 3%, but it's 5, so it's a little offset. Now I guess you could say um, if you wanted to offset this, you could put this amount starting at 8,020. But I think this makes more sense to have a starting amount of rent, and then you grow it 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Yeah, because you don't really have a period 0 on the rent. I guess the only way you could do it this way is if you say you're starting at 8,000 and then month 1 you're actually starting the increase rate. Now, if that's the case, and it could be, then you would just do if this equals start month, then I want actually to take D12 and I want to multiply it times 1 plus this rate because it's year 1. That's specific for year 1 only. Now, if that were the case, 1, 2, 3. Wait, this should be more. If L equals 7, then do D12. What do we do here? And this is just honestly, it's oh, I got to do the brackets. This is really just kind of subjective on how when you start increasing the rate. But if you want to do it, if month 1 is actually going to start increasing at your annual or your rent growth in year 1, you can. You just have to make year 1 higher than your starting amount. Now, if I did that, you can see I get to 8,240 at the end of the year, and then year 2 now starts at a new growth rate. And now you would see, if I scrolled it over and did 8,000 was my starting amount, and I go this times 3 plus this, there's my 8,240, which is here. And then at the end of the third year, I could go again at 5%, and you're at 8,652, which in this case, you're 8,652 here at the end of year 2. So you could do it like that. I guess it just depends if you want, if this is your actual rent for the month 1, or if you're increasing this by your initial amount. And depending on how you want to do it, you would have to adjust this last part of the formula to either be 1 plus the rate based on this amount, or if this is your actual rent and then you start increasing. Now, I think the more common way to do it is just simply saying if this is a start month, take D12, otherwise do the regular calculation. Oh, and you have it here, and see it's a little bit of a different number, but definitely still significant. It just depends on what your what the strategy is. So now I will only get to the same amount if my growth rate is the same in each of these years. Now I see A240 and so on, and then I go like that. So those are things to consider. Um, I believe that's it. So you've got your annual growth rate just by annual amounts only. You've got the monthly rent if you're increasing it one time each year. And you've got your compounded rent growth if you're increasing it in each month of the year to get an annual rate that's broken down into a monthly compounded rate with just that formula here where we just go rent growth and then uh, monthly compounding average growth rate. Trying to think if there's any other, and this also is dynamic where we're looking at the time frame when the property goes online as our start month, not the start month of the model, because here you could have construction or other things happening and then rent starts. So you don't really want to base it on the actual year of the model. You want to base it on the year of the active life of the property. Okay, well, that should be everything you need to ever know about computing rent growth. Um, if you wanted it to apply this to a arbitrary number, then you would just instead of um, you could just hit a 1 here, and you can see what growth factor you need to apply. Um, well, actually, that would only work for this, where you're increasing it once per year, and then each year you just multiply whatever the starting amount was by whatever the ratio is. So it'd be like, uh, you know, uh, it would be in this case 1 plus the growth rate raised to the year amount. And then you could apply that factor. So, and yeah, and you would never, you want to go by the, if you want the first year to be this, you would have to say, I want to raise it to the year amount minus 1. And that's obviously not it. And you do, if the age is 0, then 0. Now this, but see, this can't be dynamic where you're finding a different compounding growth rate in each year. You'd have to just have one growth rate, which is completely fine that a lot of models have that. And you just say, well, here's my starting rent, and I'm going to grow that rent at 3% per year. Here is what my rent is, and you just take 8,000 times this amount, or whatever you were growing by the compounded rate, and you just apply it by that, and that's the compounding growth rate. Which is just, again, it's just 1 plus the rate raised to the period that you're growing in. And year 1 is 0. Year 2 would be technically 1, and so that's why in the top here I'm doing the year minus 1, and I'm only applying it to this rate. So this is also used, this style, or the lookup style with the table, where you have different growth rates in each year. And then you have this where you're growing it in each month actually and changing, possibly growing the rents by month to get to some annual growth rate. I don't think there's anything else I've ever used, so this should be pretty comprehensive. Remember, for more, go to www.smarthelping.com for more. And again, I've got templates for real estate full models at smarthelping.com. I've done hotel development, acquisition, assisted living facilities, mobile home parks, multifamily, unit-based acquisition, property ROI calculators, rental property, Airbnb, ARB, value add, self-storage, mixed use, short-term rentals. This is a real popular one. Uh, all kinds of stuff here. I've also got joint venture, so if you want to get into cash flow waterfalls, usually they're used in real estate deals. There's all kinds of different complex financing structures here for preferred equity, general cash flow waterfall with IRR hurdles. The preferred equity on this one actually sits above, and then there's a IRR waterfall below it, so it's like subordinate. This was a pretty cool one. So all sorts of different stuff here. Um, check it out, like the video, subscribe. I'll keep doing these helpful free videos and templates as I keep getting sales. Remember, I'm trying to do a free video and helpful thing for every sale that I get. So we're trying to give back, or I'm trying to give back to you guys because it keeps the wheels going. All right, check you later.